Hey, good morning once again, options traders. Well, if you've been trading options for any length of time, you know there are some really interesting sounding strategy names. But unfortunately, the strategy names don't always convey the risks. And that's why it's so important to understand what makes them tick. And a perfect case in point is a strategy called a poor man's covered call. You hear a lot of traders talking about this like it's just the perfect solution to covered calls. Well, the question is a poor man's covered call really just a cheaper version of a covered call? So let's go find out. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. Let's start off with a covered call definition. Remember, this strategy requires that you buy 100 shares or that you've already got 100 shares in the account, and then you sell one call. By selling that call, it gives you the potential obligation to sell your shares for the strike price, no matter how high that stock price might be. So, for example, let's say that you buy 100 shares of stock for $100 a share. You then sell a 30-day $100 call, that would be an at the money strike, for $2.30. Now, the reason for this price is I've actually run these through a pricing model so we can make comparisons. So that means that your net debit is $97.70. And that just comes from taking the $100 you spent for the shares, subtracting out the $2.30 credit that you received from selling the call. So on a net basis, you have spent $97.70. So let's go see how this covered call alters your risk graph. Let's start with the shares of stock. So when you buy the shares, remember you're on this risk graph. It's a straight line, 45-degree angle. That just shows that we're making dollar for dollar up, but we're losing dollar for dollar down. Now, if you sell this $100 call for $2.30, you're going to shift from the red curve to the black. So notice the first thing is that you've capped off the upside. No matter how high that stock price rises, you can only make a certain amount. In this case, $2.30. Now, the main reason for using a covered call is to reduce the downside risk a little bit. It's a hedge. It's a very small hedge, but that is the primary reason for using it. Now, for those who may not believe it, and I've talked about this in a previous video, check out the CBOE's website, Chicago Board Options Exchange, and there you can find an index called the Buy Right Index. The ticker is BXM. You can pull it up on your broker's platform as well. And what it does is it shows a hypothetical 30-day option written every single month. And then at expiration, they buy it back. And you can see that in the long run, the BXM drastically underperforms the index, as it should, because you are taking less risk and you will therefore have lower rewards. So again, the main reason for using the covered call is to reduce this downside risk a little bit. Now we can also see that by the break-even points. Remember, when you bought the shares for 100, your break-even was 100. But when you sell that call for 230, the break-even is now lowered to 97.70. So again, not a drastic reduction. Now you might think, well, what if it's a higher volatility stock and you could sell that option for $10? Well, that's an illusion. It might look like it's a bigger downside hedge, but remember, the reason for the bigger option price is because the stock has a better chance of reaching there. So it's all proportional. But the main thing to realize is that the covered call simply gives you a little bit of a downside hedge. All right, so that's the covered call. And one of the downsides you can see immediately is that you've got to buy the stock. So in this example, I assume that the stock was trading for 100. You have to buy 100 shares because each call option controls 100 shares. So that's a $10,000 outlay. Well, is there a way that we can use the covered call but not spend as much money? And that's exactly where the poor man's covered call comes in. So remember, the main reason for this strategy is that 100 shares of stock can be expensive. Certainly a lot more expensive than a call option. So the idea of this strategy, the poor man's covered call, is that traders will buy a longer dated in-the-money call as a substitute for the stock. Now, the technical name for this is really a diagonal spread. But if you go deep enough in the money, it will tend to look a little bit more like a covered call, and so that's why they call this special case a poor man's covered call. But here's where traders make their mistakes. For example, let's say that you buy a 120-day $90 call. And for that, the pricing model says it's worth 11 bucks. You sell this same 30-day $100 call again for $230. See, now your net debit is only $8.70. That's a whole lot better than $97.70 that we saw by buying the stock. So again, where traders get tripped up is they'll say, well, hey, if spending $11 is better, why not buy a higher strike call? Maybe buy the 120-day $95 call. Now I only have to spend $7.50 by selling this call for $230. Now I've only got a net debit of $5.20. And that's a whole lot better than spending $10,000 for the stock. Well, yes, dollar for dollar, there's no question that's better than spending the $100 for the shares of stock. Unfortunately, people think that because a call option is in some ways a proxy for shares of stock, maybe at expiration, but certainly not today, they don't realize that by buying a 120-day option as a substitute for stock greatly alters the risk graph. So let's take a look at these two. Let's look at this one where you pay the $11 for the $90 call, and then we'll look at this one where you're paying $7.50 for the $95 call. But in both cases, you're going to sell the $100 call for $2.30. So in the first case, this is your risk graph. This is buying the $90 call and selling the 30-day $100 strike. So this risk graph is shot at expiration of the short option in this example of the $100 strike. So there's a couple of key features that really stand out here. Notice that instead of having that straight line for the covered call like we saw with the shares of stock, you actually curve out this way. And that's because the call option can only lose the amount that you paid. And that's not nearly as expensive as the shares of stock. But the bigger thing to notice is up here. This is not a flat line. It's actually sloping down a little bit. Now in this case, it's not too bad, but it's certainly not the same as a covered call. But where traders make their big mistake is they'll say, well, hey, if I bought the $90 call, why not buy the $95 call? And so they go from this black curve to the blue. And you can see that you are nowhere near the look of a covered call. In fact, this is more of a calendar spread. It's a neutral outlook. So you can see that there's a very big difference in this maximum gain. In fact, if the stock price rises with a traditional covered call by using shares of stock, you're going to be fine for any stock price above the strike. It will be limited gains, but it absolutely will be a gain. But in this instance, it's not. And that throws traders. They'll say, hey, this is great. The stock is going up. Who cares that it went up above my strike because I've got this maximum gain? Well, you don't. You're just heading further and further into losses. And that's because you didn't push this long call strike deep enough in the money to mimic shares of stock. So if we do a comparison, here is the covered call by using shares of stock, selling off the 100 strike. If we buy the 95 call that we just saw in the previous slide, there it is. Very different look. Now, it is true that you have a whole lot less to lose over here on the left side if the stock falls, and that's where most traders are focused. But they assume that the right side looks the same. And you can see that if you don't push those deltas high enough on that long option, these deltas will roll over on you and become negative. And that's what throws traders and causes losses in what otherwise might be the appropriate time for using a covered call. So notice in this instance that by using the 95 call, it becomes more of a neutral strategy. It's behaving far more like a traditional calendar spread. And that's very different from a covered call. Those are two completely different outlooks and used for completely different reasons. And yet many traders think that the two strategies are identical. So remember to be careful. Strategy names don't spell out the risks. The poor man's covered call is not necessarily a cheaper version of the covered call. Now, it may be if your long call is deep enough in the money. How far is deep enough? Well, I would say at a minimum, you've got to get those deltas up to 90 preferably more. There are exceptions, but if you're unsure, get those deltas up. So let's say if you bought the 120-day $85 call, and according to that same pricing model, it would cost $15.30. And once again, this is where traders say, gosh, that's a lot. In the previous slides, we saw you could buy the 90 call for 11 or the 95 call for 750. Why would I want to spend $15.30 when I can buy another strike for so much less? Well, you're going to find out why. So let's buy this one, the 85 strike, for $15.30. We'll sell the identical 30-day $100 call for $230, and now your net debit is $13. Yes, it is more than the ones that we saw for the total net debit, but take a look at your risk graph. Now you can see that over here on the right side, it's just depressed a little bit compared to the black line. Remember, that's the traditional covered call. The blue line has just ever so slight negative deltas out here. And that's because the long call had super high deltas. It is behaving a lot more like shares of stock. And that can be seen right in this region where the blue and black lines are virtually overlapping. However, if you're dead wrong and the stock really takes a nosedive, you do get the benefit of having this reduced loss. Now granted, it's still bigger. It's $13 compared to the other ones that we looked at for $11 or $7.50, but it's still a whole lot better than $100. And that's really the perspective that you need to take if you're trying to use this idea of a poor man's covered call. Make real sure that the deltas on the long are pushed up there. Otherwise, instead of being on this blue graph, which is probably what you're thinking, you might end up on something like this. And that's a very dangerous position if you think that you're up here on this black graph. So the key is always about the right side of the chart. Yeah, we know by using a call that you're going to get this limited downside. And again, that's where traders focus, and that's what makes them think to buy higher strike calls with lower deltas. But the key for this poor man's covered call, is the right side of the chart. You want to make real sure that on the right side here, you are relatively flat. But if you're too focused on spending very little money, you're going to end up on a graph like this in red, which is really more of a calendar spread. So again, the main thing to be sure of is that if you want to use this idea of a poor man's covered call, be sure to get the deltas on the long call high enough so that your risk graph is closer to this black line instead of the red. So before you use any strategy, don't rely on the name to spell out the risks. Instead, be sure you understand how they work. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.